Can you hear me, Jess? All right, getting ready to start here in a minute. Let me see if you can hear me. All right, got confirmation you can hear me. All right. I am now going to get started. So I'm sure some people will join us in a smidge. But for those of you here, let's get cooking. This is the time. So good afternoon. I am Dan Romero. I am the advisor for your company 401k plan. Or we may have some individual wealth management clients here as well. So welcome. But this is going to be basically the same information we went over yesterday, just geared a little bit more towards our participants in the 401k plans. So we're going to have an equity update of what's going on with the markets and also some tax planning ideas that may apply to some of you in here. So let's get in and get this cooking. What we're looking for is to have our participants and our plans as educated as possible. So that's why we've been doing these things. This is our third one of the year. We'll try to do these, 2 or 3 times each year just to give you an idea what's going on. Again, we're going to be looking at the economy and some tax planning ideas. We are a full service 401 financial planning firm. So for those of you participants in the plan, we do offer retirement analysis, all different types of planning opportunities for you, and it does not come at an additional cost. So it's included with the plan. So keep that in mind if you want to talk a little bit more specifically about your situation. So let's dig in. In 2022, it's moving a little bit away from us now, but 2022 was a rough year. The stock market and the bond market both fell in a pretty good way. What was going on? We had fears all over the place for a recession, potential world wars with things that were going on with Ukraine and potential things with Taiwan and China. Inflation was an issue. Interest rates were going up. The government was threatening shutdowns. All this kind of stuff was going on in 2022. You could argue that stuff is still going on in 2023, and maybe even a little bit worse, but the stock market has rebounded, you can see here, in a pretty good way. So those of you that stayed the course with the stock market were rewarded a little bit by seeing a market rebound here. Now, when you look at equity investments, your stock market parts of your 401k portfolio, you want to consider that for long term. So if you're looking to retire in 3 months and may need to use the money for some type of thing, then that would be a short-term goal. But if you're 10, 15, 20 years from retirement, that's where your equity portion of your portfolio is going to come into play. So what are our areas of concern? We still continue to be concerned about inflation, the interest rate changes, recession seems to be more likely as each day passes, and the geopolitical risks that we see out there. Now, when we start with inflation, we're going back to 2005, you can see where it's hit. For a long time, inflation was pretty low, but we had a huge spike up coming out of COVID with all the money that the government spent. Then the Fed started to lower interest rates. And so now in August, we saw the inflation rate down to about 3.7%. But we still feel it in our pocketbooks because we're still pretty high coming off of last year. So that's certainly a problem that exists still. Now, interest rates, this is a whole nother deal. For anybody that's been looking to buy a house or refinance a house, anything along those lines, you've seen rates shoot up. So if you look at the bottom of the chart here, you see that rates were at 0.25, 0.5 in March of last year. Now they've zoomed up to 5.5, even north of that, because we've seen another interest rate hike even since this slide was put together. So rates went up in a huge manner. Now, what's going on here? Inflation backed off for a little bit, starting to tick back up again. So it looks like the Fed may raise rates one more time. That will affect the bond portion of your portfolio. If you're not totally clear what that's about, you can always call us. But anytime rates go up, we're going to see the value of bonds decrease. So we do expect rates to continue to go up in a very small manner, not much like what we saw last year. But it could continue into 2024. So the Fed is continuing to watch. They want to see inflation at around 2%. This is a chart just to show you historically where we are with interest rates. Now, when you consider the last 15 years, it's been very, very low. If you look down here on this end, from going back to 2008 all the way to today, rates were pretty low. But if you really look back historically, particularly when you look in the 70s and the 80s over here, you can see rates have really been much higher than where we are today. So even though rates are high, it feels like they're much higher in consideration of where we were recently. But historically, going back to the 70s, we are probably right in line with where things have historically been. It doesn't make things better. It just tells you kind of where we're at. So again, when we talk about interest rates, when one of the good benefits of it now is, again, if you got a credit card debt or you've got a loan on your house and you're trying to refinance, not great. But if you're looking to get CDs, bonds, things like that, they're all paying much higher rates right now. So that's good. So even within your portfolios, then the 401k side, if you are using bonds or fixed income, you should see a little higher interest rate on there as compared to last year, much higher interest rate. The other concern we talked about is going to be recessionary things. A lot of the stuff that the Fed is doing as it pertains to increasing rates can sometimes have a lag. There are certain industries that have really felt it when we look at real estate and anything along those lines, but recessionary things seem to be ticking up, and we may be hitting into something like that towards the end of this year or next year. So we've got our eyes on that. The geopolitical risks continue to get hairier and hairier. The Ukraine-Russia debacle continues to go on. Nothing of any substance has really happened with China, Taiwan. We were fearful of that last year, but that isn't necessarily put to rest by any stretch. And now, of course, the new activity that's going on in Israel. So there are things going on. But what I would always say is be careful what you read out there on both ends of the spectrum. If you're looking for it, you can probably find it. We found this amusing. Back in September, Business Insider put up two headlines on the same day. So the one on the left says, the stock market is going to crash, recession will sink the S&P 500 by 40%. On the same exact day, they had another article that said why the stock market could rally 25% in the next 12 months. So if there's an opinion you're looking for, it's out there. Just be careful, and we are a resource for you that if you want to really dig into it. And if you do have a fearful, we can help educate you on how you might want to realign your portfolio. We can't give specific recommendations, but we can help give educations on things to consider. So now, when we look at what we're in for, doesn't necessarily mean anything beyond the fact of what history has done. But the fourth quarter has tended to be the best performing quarter for the S&P 500 for the market historically. So, you know, where we're at right now means hopefully we're in for a nice little close to the year. Again, when you look at equity investments, you want to look at over the long term. This is your stock market stuff, and you can see the trend is, even though there are ups and downs over the 10, 20, 40 years, you can see here that the market continues to work its way up. But in between, you'll see some turbulence in there. It's just an issue of how you ride through it. But looking at the stock market and equity investments over a long-term perspective is smart. But again, we continue to preach caution. Be careful. Historical returns don't necessarily translate into future returns. It just means it's an indicator we can see. So keep an eye on things. What you control is your risk tolerance or appetite. If you're not sure how much risk you're willing to take, give us a call. We can walk you through that. Your time horizon, when are you going to retire? Are you going to retire in 2 years? Are you going to retire in 20 years? If you have a longer time horizon, it's a little bit easier to ride through these things. What your behavior is, you know, are you someone that panics when things are going rough? If that's the case, then maybe we need to dial down what you have in the portfolio a little bit, and then ultimately look at your overall strategy. What type of assets do you have outside of the 401k? How does that fit your portfolio? Warren Buffett, we love this quote that you have to say, but the most important quality for an investor is temperament, not intellect. So a lot of folks feel they need to be the smartest person in the room to manage their 401k. It's not necessarily the case. The trick is to figure out where your risk is and then ride through where you're at. Continue to add money into the plan and go from there. Again, some key takeaways from this part of the presentation. Caution is where we're at. That's our principal notion for investors. Inflation is going to continue to be a catalyst, as well as rising interest rates. Recession still appears to be a possibility. And keep in mind that if you're invested in the stock market, take a long-term approach. Now we're going to move on to some tax ideas. And I didn't mention it earlier. If any of you have any questions, feel free to type in the Q&A tab up above. And at the end of the presentation, I'll attack those. So just type it in there now. If it's hot on your mind, then I'll get it at the end. But from a tax planning perspective, we like to be a little bit more proactive than reactive. We are not CPAs. We don't do taxes here, but we try to look at everything through the prism of taxes and see if there's ideas that could potentially help you. So that's, again, where we don't prepare them. We just try to do some planning for you. Now, this is some insight. The tax brackets that we've enjoyed for the past 6-7 years will continue to stay in play. They're relatively good historically, so you're not going to see too much on that front. Maybe this is all scheduled to phase out in January 1st, 2026 if nothing is done, and it would return back to the old rates. But right now we still have these favorable rates. We have a slight increase on the standard deduction amount. So you can see that a single individual is $13,850. And then married filing jointly is $27,700. If you have questions about this, talk to your accountant, but the deductions did go up a smidge. You know, with regards to those of you that itemize, the old rules was to accelerate, try and get as many of those deductions this year, but you want to plan it out now, work with your CPA to see maybe it makes sense to wait to next year, because we are in pretty favorable rates. Capital gains, a lot of people aren't aware of this, but for folks, there is a 0% capital gains rate. So these would be assets outside of your 401k. Maybe you have some stocks, some mutual funds, whatever it may be, but there is opportunity to pay a 0% tax rate depending on where your income is. So you can see if you're married filing jointly, if the total income is less than $89,000, there is a 0% capital gains rate. So sometimes that happens where people switch jobs. They don't have a high income right now, and they can take advantage of selling some things that are not inside of their 401k or IRA and enjoying that 0% tax rate. Most people are going to fall in the 15% capital gains rate. And then, of course, 20% for those making a lot more than that. So now we'll look at some year-end strategies. Again, this does not apply to assets that are in your 401k, but if you have assets outside of your 401k, you potentially could harvest losses. If you have some positions that are down, you can bank those losses and use up to $3,000 towards your ordinary income. So it's a really good way to save on taxes. And again, if you're in a lower income bracket and you do have maybe some positions that have big gains in them, you could harvest gains and maybe potentially get some 0% tax payments on those. So again, this is something you want to keep in contact with your accountant. Now, as it pertains to retirement savings, we want to go over the rates. So everybody in here is in the 401k, so we'll focus on that. So if you are under 50 years old for 2023, you can get as much as $22,500 into the 401k. If you're over 50, there's a catch up of $7,500. So you could get as much as $30,000 in. The clock is ticking on that because we are in October here. So you would need to get that through a salary deduction from your paycheck if you were doing that. So if you wanted to try and bank it. The Roth and the individuals are $6,500, under 50 and 1,000. You need to make sure you check with your accountant to see if you're even eligible to do a Roth if you do have a company 401k plan. But this is the one that's most relevant. So Roth conversions, they're a topic that we always hear about. They help lower taxable income over the long term. You get some tax-free compounding. You don't have to take any RMDs. An RMD is where the government forces you to start taking money out of your IRA and your 401k. And it's an interesting way to move some tax-free withdrawal to your beneficiaries. It doesn't work for everybody, but it is something that is popular these days. So a way to look at this here, presuming you have money in your IRA that you don't necessarily need, or your 401k, if you're in a very high tax bracket and your beneficiaries are in a lower tax bracket, it doesn't make sense to convert. But if you're in a lower tax bracket and your beneficiaries are in a higher tax bracket, you could convert right now and save the family, so to speak, less in taxes. Not going to, you know, I mean, with the 401k, if you want to get into conversions, that'd be something smart to give us a call about. 529 plans are another great way to get some tax efficiency. If you are saving for a child's college, if you save inside of a 529, the growth does occur tax-free if you use it to pay for a qualified expense, tuition, books, things along those lines. So this is another interesting way to save for college. Some states do offer tax benefits for this. We're based out of California, so in California here, there's no extra benefit for putting in the 529 from the state. For those of you in the gift-giving business, or perhaps are receiving gifts, you can give up to $17,000 per donee. So that's where we're at on that, without avoiding any items. If you do give more than that, or if someone is looking to give you more than that to avoid gift taxation, they can use part of their lifetime exemption, which you can give away $12 million per person during your life. For those of you that are in the RMD age, if you don't need that money, you can get that as a qualified charitable distribution, get it to your favorite charity, and avoid the taxes on that. So see us if you're in that phase. Most folks in the 401k plans aren't there, they're saving and not necessarily in retirement. But what are things to looking ahead of what's going on? As mentioned, the rates that we have right now are expected to sunset in 2025, at the end of 2025, going to 2026. So if the government hasn't addressed that, then we will return to our old income tax levels, which were higher. For those in California and some of our high income states, the SALT cap will disappear, so that could be a potential benefit for folks. Child care tax credit will revert back to $1,000, and then we would welcome back the alternative minimum tax, which isn't fun for a lot of folks. So I'm sure things will be taken care of before, but those are just things we got to look at. So again, we are coming to the year end here. If you want to look into more aggressive tax planning, just give us a call. We can help you with that. Again, we're not going to prepare your taxes, just things that we can give you some ideas about. But ultimately, as it pertains to participants in the 401k, we are a resource here for you. Most 401k plans don't have anything like this. You can call us, you can speak with us. We have another gentleman in the office here, Greg Toby, who's also an advisor. So if we get busy, there's a couple of us that can answer a lot of questions for you. Feel free to share if you find it of value. You know, let people know, let your what is it called, the plan administrator know that, hey, we enjoyed this. This was useful. We're always willing to help others, but I'm going to keep these disclosures up here so that everybody has time to read them, but also use this opportunity to see if there are any questions. And right now we do not have any questions, but if you do, feel free to toss them out right now. If you have something that is more specific to your personal situation, just email me. My email is dan.romero@lpl.com. And you can also call me, and my number's on there, 714-547-8787. And of course, just contact your plan administrator if you're unsure about how to get a hold of me, but we're there. So again, we appreciate the opportunity to assist you. Any questions at all, just feel free to reach out to us. That's all we got for today. Have a great weekend. Take care.